Hi everyone, I'm Debbie Roberts, owner and financial advisor at Property Apprentice. Join us today for the Week in Review, where I talk about current events for the everyday investor and home buyer. Our topics for this week. Topic number one, as most of you will be expecting, from Oneroof on the 29th of October, capital gains tax fallout. House prices are not going to fall another 20%. Topic number two, from Good Returns on the 28th of October, bets are on for OCR to fall even further. Topic number three, from Stuff on the 30th of October, biggest bank thinks house prices will rise this year after all. Topic number four, from One News on the 30th of October, new granny flat rules could put rates up, economist says. So we'll start with Oneroof on the 29th of October, capital gains tax fallout. House prices are not going to fall another 20%. Labor's newly proposed 28% capital gains tax, or CGT, on property sales, excluding family homes and farms, has been met with scepticism from economists and industry experts. The tax is intended to take effect in July 2027 if Labor wins the next general election, with forecast revenue rising to $969 million in the third year. Experts doubt the policy will achieve Labor's goal of improving housing affordability or significantly curbing house price growth. Kiwibank Chief Economist Jared Kerr and Cotality Chief Economist Calvin Davidson both questioned the effectiveness of a capital gains tax in controlling house prices, with Kerr citing the limited impact of similar taxes in Australia. Ray White co-owner Tom Rawson predicted that some investors might sell up before the 2027 start date to avoid the tax. Davidson suggested investors might simply change their behaviour to avoid selling, noting that the policy could be a way to disincentivise property investment in favour of assets like shares or KiwiSaver. Davidson also suggested that the tax might not generate the huge amount of money Labor forecasts. Rawson added that the government should be prepared to cover capital losses, stating that the tax cannot selectively target profits while ignoring losses. The New Zealand Property Investors Federation stated that the policy unfairly targets property investors who provide rental accommodation and called on Labor to ensure the tax allows for deductions on repairs, maintenance, upgrades and inflation. Infometrics chief forecaster Gareth Kiernan noted that the policy's potential introduction is likely to further stifle investor demand. He suggested that if a capital gains tax is introduced, investors would likely seek a realignment of their rental yields, which could lead to house prices pulling back to raise rental yields. The total potential market affected includes over 500,000 investment or secondary homes, representing about 29% of the market. My thoughts on this, where should I start? So let's start with the effectiveness of capital gains tax in controlling house prices. I mean, Australia's not only got capital gains tax, but it's also got stamp duty. And in Sydney, as an example, house prices on average are 1.7 million compared to in Auckland, where they're about, 950 or something. So, it doesn't stop capital gains. It doesn't stop house prices from increasing. I think potentially the most significant impact that this could have is there will be some landlords who are nearing retirement and they might just decide, you know what, let's retire a little bit early, downsize the portfolio before the capital gains tax kicks in. And if that happens, bearing in mind we've got an aging population and a lot of the baby boomers were encouraged to invest in property. So if we've got a larger number of baby boomers retiring and selling their rental portfolios, we could end up in a similar situation that we had when the previous government introduced changes to interest deductibility, when they removed the option to deduct the interest for tax benefits. So, the same thing could happen. We saw rent increases by up to 9% in a 12-month period. So, the only people that are really going to suffer from this are the tenants, because if there's less rentals available and high demand from tenants, then rents increase. So, I think this is short-sighted. Not to mention the fact that, we've already got a shortage of GPs at the moment. So their plans to use capital gains tax to fund 3 GP visits for free a year. What is that going to do to waiting times and put pressure on the GPs even further? So I think that, shockingly for some of you, this might be a poorly thought through proposal aimed at further dividing the country into those that have and those that have not. And I think from, judging by some of the comments on social media so far, it's doing its job. Oh, there's been certainly an increase in the number of anti-landlord commentary on any news links like this. So, I think that it is important to remember that, I don't think that we're going to see investors changing their behavior to, invest further into shares or KiwiSaver instead of property investing, because property investing still got the powerful benefit of having leverage, which means that your net worth will increase faster, even with smaller capital growth. And even if you do have to pay capital gains tax, then, I think potentially investors that decide to hang in there will just hold their properties for longer so that they can make a bigger profit even after paying capital gains tax. But I think it's short-sighted behaviour from the opposition. I think it's just trying to grab a few extra votes from people that won't be affected by this tax bill. Second topic for this week in review: from good returns on the 28th of October, bets are on for an OCR to fall even further. The latest increase in New Zealand's Consumer Price Index, or CPI, was driven by rising costs for food, electricity, and local council rates. However, Westpac reports that price pressures in the discretionary and cyclical areas of the economy are subdued, which is a significant factor for the Reserve Bank of New Zealand. Senior economist Satish Ranchod stated that when combined with an expected easing in food prices, overall inflation is forecast to drop back to levels comfortably within the RBNZ's 1 to 3% target band over the next 12 months. This underlying trend is particularly evident in housing costs, where rental inflation has fallen to its lowest level since 2019, without a capital gains tax, I might add, and construction cost inflation is also at its lowest since 2009, again, without the impact of capital gains tax. This contained medium-term inflation outlook, alongside an economy still operating with spare capacity, provides the RBNZ with headroom to continue cutting the official cash rate. Westpac is consequently forecasting one more 0.25% rate cut at the Reserve Bank's November meeting, which could bring the OCR to a predicted low of 2.25%. Ranchod explained that the full effects of stimulus has been slow to hit the economy because about 90% of New Zealand mortgages are fixed for a period of time. As a result, even though interest rates have been dropping for some time, a material fall in households' debt servicing costs has only been seen since the middle of this year. The bank will now be closely watching for signs that spending is starting to increase as the country heads into the summer months, and it will also monitor gauges of the job market following the September quarter update scheduled for November 5th. Third topic for this week in review: from Stuff on the 30th of October, biggest bank thinks house prices will rise this year after all. ANZ has revised its house price forecast for the year, now predicting that values will lift over the final months of 2025. The bank's economists, who'd previously expected no house price growth this year, made the change after noting that the falls of winter appear to be over, with the Real Estate Institute House Price Index showing a 0.3% rise on year. The key driver behind the updated forecast is the Reserve Bank cutting the official cash rate faster than anticipated, with ANZ now seeing the OCR falling slightly further to 2.25%. The bank believes that this will give the housing market more support than previously envisioned. In light of these factors, ANZ now forecasts house prices in the fourth quarter of 2025 to be up 0.5% to 1% year, rather than being unchanged. For the next year, the bank anticipates prices will grow by 5%. Economist Matthew Galt noted that the trend will feature regional differences, with areas supported by strong rural economies seeing modest growth, while prices in Auckland and Wellington have been flat or falling. Galt emphasised the significant role of rents in weighing on house prices over the past year, attributing the low growth to a weak economy and improved housing supply. He stated that if rents on new tenancies had followed their long-run average increase of 4.5% instead of falling by 1%, the modelled house price would be 9% higher. Home ownership running costs have eased from their 2022 to 2024 highs and are now back in line with their historical relationship with rents. Galt expects these costs and rents to remain in balance, pointing to a broad price stability with a potential modest increase next year as the economy cyclically recovers. While falling rents, high council rates and insurance costs have been a drag on house prices, ANZ expects these factors to be much less of an issue going forward. The slowdown in rent inflation is partly due to the economic cycle, as factors like wage growth and employment affect the rental market, as well as the housing market. However, Galt also noted that housing construction has held up better during this downturn than in previous ones, and this extra supply will help keep a lid on rent inflation, even as tenant demand increases next year. My thoughts on this are it's a moving beast. We've got an oversupply of some types of properties, like particularly some 1 and 2 bedroom apartments or townhouses in parts of the country. But then that could balance out quite easily as the economy recovers and people move back into their own places again instead of moving back in with family or friends to make the cost of living a bit more affordable. If we get more migration, as net migration increases back to more average levels, that could quite quickly soak up some oversupply of different types of properties. And I'm fully expecting house prices to increase next year. But no one's got a crystal ball that works, so we shall wait and see who was right with their predictions. Topic number 4 from One News on the 30th of October, new granny flat rules could put rates up, economist says. New legislation simplifying the rules for building granny flats could lead to increased costs for ratepayers, according to economist Brad Olsen from Infometrics. Olsen argued that a property with a granny flat would presumably see an increase in local rates because the additional unit would also be using local resources. If rates were not increased, existing households would effectively be subsidising properties with the new flats, as the increased use of local resources would be unfunded. Local councils confirmed that the construction of new granny flats is likely to trigger additional charges. Spokespeople for Masterton and Carterton district councils stated that rates are based on whether a structure is occupiable, not its size. If a new structure includes a toilet, shower and kitchen sink, it's considered occupiable and will attract additional fixed charges for services such as water, sewage and roading. They added that building a granny flat may also affect a property's overall valuation, which could impact valuation-based rates. In other words, if the value of the property increases, then the rates could also be increased due to that. Similarly, the South Wairarapa District Council rates secondary dwellings based on whether they meet the definition of a separately used or inhabitable part. If a new granny flat meets this definition, it will attract additional fixed charges, including those for water and wastewater. It may also increase the property's capital value, which affects value-based rates like general rates, as mentioned earlier. In announcing the legislative change, Housing Minister Chris Bishop explained that the goal is to make it easier to build homes by removing complex and expensive consent processes for simple dwellings up to 70 square metres. Bishop stated that these multi-generational units are part of the solution to the housing crisis, providing more options for various groups, including grandparents, young adults and rural workers. He also noted that councils can charge development contributions to recover the costs of growth associated with the new units. Building and Construction Minister Chris Pink added that the legislative change, which is expected to deliver approximately 13,000 more granny flats over the next decade, could boost productivity in the construction sector by freeing councils from managing unnecessary consenting burdens. The new exemption is expected to come into effect in 2026. My thoughts on this are that if you do see an increase in rates, you've increased the value on your property and potentially also increased the rental return on that, because it's certainly cheaper to pay a little bit of an increase in your rates than to buy another piece of land and stick a dwelling on top of that. Are you ready to turn these new laws and recent property market changes into opportunities? Whether you're a first home buyer looking for security or an investor navigating falling rents and new regulatory risks like occupancy limits, you need a strategy designed for today's market. Join me at one of our free events called How to Succeed with Property Investing. These events are all available online, so you can gain valuable insights and strategies tailored to today's market conditions, regardless of where you live. Whether you're an experienced investor or just getting started, this free session will equip you with the key tools and insights to make confident, informed decisions. Don't miss out. Register today and take the next step towards reaching your financial success. In our free events, I'll also tell you more about how we could help you as a client to achieve your investing goals. So if you're interested in finding out more about how we could help you, visit propertyapprentice.co.nz and register for one of our free events today. If you've already been to one and you'd like to know more about how we could help you on your journey, or you really enjoyed the session, feel free to spread the word to friends and family. And if you're interested in finding more about what we could help you with, book a no obligation phone call or meeting with my husband, Paul Roberts, through our website. And that's propertyapprentice.co.nz. Thanks for listening. Hey there, want to stay on top of the latest property news and trends? Subscribe to the Property Apprentice podcast for weekly updates that will help you to navigate the market like a pro. We cover everything from insider tips to expert interviews, so you'll always be in the know. And don't forget to ring the bell and hit that subscribe button here on our YouTube channel for even more helpful content to boost your property journey. Check out the link in the description to subscribe to the podcast, and we'll see you in the next episode. Happy investing.